Hello, YouTube. My name is Justin, and this weekend we're going to pick up where we were about 2 weeks ago, where we were talking about the potential for a stock market crash. And now, with some evidence, we have to lay out what a bear market for 2022 would look like. This video is going to be long, and this one should be recorded properly like it wasn't 2 weeks ago. So it's going to be used as a template as we go forward to just try to understand what would a bear market of 2022 actually look like. And most importantly, how can we be prepared going into this? And the reason why it matters this week is because there are a lot of not only warning signs, but now confirmation that we are seeing things that are going to be harder to unwind than they are to just for us to self-fulfill. So more importantly as well, we also have Jerome Powell speaking this week. He is going to have his FOMC press conference on Wednesday. And with all of this, it means that if the wheels are in motion and we're going lower, we have to be aware of that because we're still going sideways. We've only technically just started going down. And we haven't even lost a 50 moving average on SPY yet. So what does that mean? Let's jump straight in. We got a lot to unpack. And like I said, I would really appreciate your support this weekend by smashing the thumbs up and drop me a comment because this took me an incredible amount of time to prepare this PowerPoint. It's a long one. It's super detailed. And what I'll say is that I have been feeling this bearish rhetoric because I have an understanding of economics. I'm by no means Ray Dalio or Jeff Grunlock, but I've not been quite able to articulate exactly what I've been looking for in terms of actually laying out a story. So this weekend, I think I got it. And if there's things that are wrong, I highly encourage you to, first of all, correct me. I am human. I do make mistakes. And if there's things that are missing in my analysis, please make sure to let me know as well. And I'm wearing my green shirt this week because I'm hoping that I'm wrong. So again, if you see any evidence that I am wrong, please make sure to let me know because if I'm missing something, if I have a blind spot, I need to know because it's more important than ever that we are united. We're working together to conquer Mr. Market. All right, so I'm going to start going through and I'm going to take as long as it needs. I'm not sure how long the video is going to be. But again, like I said, this will be a reference point for future weeks so we can look back and see is what was laid out unfolding. All right. Nasdaq 100's unrelenting decline ring a dot-com bust alarm bell. Tech heavy gauge down at least 1% every day over the last week. Views it as an ominous signal for the market. What does that mean? Let's jump in. The last hour selling and the consistent selling each day does seem like institutions are done being patient and rushing to get out, said Chris Murphy, co-head of derivative strategies at Susquehanna International Group. Oh, right. That kind of explains the price action from the last few days, right? Institutions are getting out and these guys own a lot of stock. So the most strategic time to dump it is at the end of the day, especially on an OPEX week where 3 out of 4 days had options expiry. So not only are tech stocks flashing a mega warning, we also see Bitcoin. Bitcoin has lost half its value since hitting record high. Crypto crash erases more than 1 trillion in market value. Nasdaq 100 unrelenting declines ring a dot-com bust alarm bell. There you go, right? The case for digital gold unravels as Bitcoin plunge deepens. This is not looking great. So the reason why we're talking about Bitcoin this week as well is because it's not really acting as the risk asset we would have normally expected, or again, the digital gold like we've been getting told. Bitcoin's past performance suggests the asset class is less like gold and more like stocks. In prior stock market corrections, Bitcoin plummeted while gold served as an effective hedge. The correlation between Bitcoin and high growth benchmark ARKK still stand at roughly 60% year to date. Right? Fair Leads, Kathy Stockton said in a Friday note. What does this mean? It means that when the stock market opens, Bitcoin is pretty much tracking what the Nasdaq does. And normally there was not as strong of correlation between these risk assets. But if we're seeing an unwind of all assets, that would make sense because when the selling starts, they're selling across the board. All right, let's move forward. So if those two things are correct, I'm going to share something with you that I have been using as my template for ES or the stock market, S&P E-mini futures going all the way back to October. So what you're going to note here is that this is the expansion that we saw here in Bitcoin from October to its all-time high at 69,000, roughly double topping. And now here we have that same chart on ES. So over here, again, we get the mega pump. We put in 3 consecutive highs. Here we got 3 consecutive highs, each one being higher. And then we have 4 lows. The first one going off the 50 EMA. The second one's not quite at the 50, and then the third one losing it. So what do we got here? Oh, the fourth one, sorry. 50 MA, 50 MA, 50 MA, and there we go, right? Low, higher, low, higher, low, higher, low, and then lost. Low, higher, low, higher, low, higher, low, and then lost. So what is this? I've been using BTC as my leading indicator for the continued move. It worked excellent on the way up. It worked excellent on the double top. It worked excellent on the rejection over here. It also worked excellent once we lost the 50 MA and printed a lower low. So the question is now, I had this dot, the circle drawn right here on ES. I had a yellow pocket, which roughly aligned with February 2nd, which is where I thought we would bottom out. We hit the target, basically. We're inside the pocket. There's a gap here at 436 on SPY, and it's technically now filled in after hours on Friday. So the question for me is, are we going to get this snapback, or are we just going to continue the fade and take a fresh leg lower? So I don't know. For me, technically, we have hit enough of the pattern on this side for us to get some relief. I don't know what's going to happen into Monday, but I know that this template has worked excellent for us. So I'm going to continue to rely on it. And it's also telling me that, again, it's hard to ignore this data now. So again, hopefully you appreciate this content. And if you do, please destroy that thumbs up. This move worked excellent for our entire team, myself included, during October to the end of the year, where we saw that, oh my God, it's perfectly setting up. Power pump over the 50 MA, back test the 50 MA, new high, and then it just took off. And that was one of the best trading periods for me last year, was this period right here. I wanted to get bearish. No one else was really willing to get into the big bear camp with me. So I didn't quite pull the trigger on trades that I laid out, but I've been bearish for a while, and notably bearish since the beginning of the year. So let's move forward. So there was that comparison to Bitcoin and ARK from before. So if we're seeing evidence that we're now going into the corrective wave or a bear market for 2022, are other risk assets signaling the same warning here? Yes, they are. So what do we see? This is ARK. We shared this 2 weeks ago on the January 9th. I believe it was that weekend, January 9th, weekend deep dive. Here we see the psychology chart, which I have used as my template for any market cycle. This is 100% accurate once we're actually completing the cycle. You also note over here that simplified market cycle, we go up, we go down, we go up, we go down. So at the top right here is where we have peak point of maximum financial risk. At the bottom is the point of maximum financial opportunity. So now I have a couple lines drawn here to just try to show you on the next chart where ARK is currently in this move. And when I laid it out, we were sitting roughly here. We were sitting roughly here in denial. My investments are with great companies. They will come back. We're in deep value territory. You should buy the dip. Hold on for 5 years. Isn't that what we said? That's exactly what we said. So now let's look at ARK chart. Oh God. So we were sitting about right here 2 weeks ago. It looked like maybe we were going to invalidate the chart. Boom, inverted hammer. Boom, continuation lower, losing the 200 weekly moving average. Long-term support on a weekly time frame. We also know we got volume ramping up here. What does that mean? It's an exodus. People are running for the door. So again, let's look over here. We got our slingshot all the way up. We got our head and shoulders pattern. There's our low connect. There's the relative high, and we lose it. So what happens? Now it is easier to go down than not. The next stage of this is panic. Shit, everyone's selling. I need to get out. And then the next one is capitulation. I'm getting 100% out of the markets. I can't afford to lose more. So I'm starting to see some of these rumblings on social media, including Twitter, including Reddit, including YouTube, but I don't think we are anywhere near the bottom. So I think that right now people are squarely in denial. So what does that mean? They're saying, my investments are with great companies. I should buy the dip. They're going to come back. So again, looking here one more time, right? There's our slingshot up. There's our, there's our head and shoulders with the purple lines. There's our triple bottom, and there's our rejection for the confirmation. What does this mean? This is not the bottom. What I was talking about when I laid this out last time is actually retesting this relative range right here at between, I think it's like 30 to 40 bucks. This previous top right here. That's a lot lower than we are right now. Maybe it's 50. Please correct me if I'm wrong. So what is the key takeaway as we think about this? Because you might already be like, whoa, Justin, you're going in head first into the bear market here. Yes. Why? Again, if you look at the thumbnails for the last few weeks and maybe the last few months on the channel, I've been having a hard time figuring out a clear trend. And remembering that the YouTube algo looks for what people are searching for. So that's what we try to optimize the thumbnail for. There is no doubt this video is a bearish one. But what I want to leave you with is a little glimmer of hope, a key takeaway. Why? If you don't want to short the market, don't know how to short the market, don't feel prepared to do any of these things, there is one simple thing you can do to help yourself, which I did not do through the first 2 cycles that I traded. I traded gold in the mid-2000s, and in pot stocks, I fell victim to the same trap, but to a lesser extent. I was able to recover it all, and here we are today. So the key takeaway is this. If you lose X%, on the right-hand column, we see how much you need to make to get your money back. So the completion of a full bear market would be 50% decline. So what does that mean? If you lose half your money, you need to make 100% to get your money back. However, if you can avoid a 50% drop and buy the right dip, not just any dip, you can double your account. So what does that mean? Again, let's pretend that the wheels are in motion for us to go into a bear market, 20, 30, 40, 50%. And again, I have evidence to support that as we go further into the PowerPoint. If you can avoid the 50% drop and buy the right dip with early confirmation, by the way, we sell an algo that tells you when the bottom's in with early confirmation. What does that mean? 100%. So if you've been taking some lashings over the last few weeks, maybe the last few months, you're not alone. Everyone's underperforming the market, everybody. And if we look at these numbers here, let's keep this in mind as we go into this week. Why? Again, let's pretend you've lost about 10%. Market goes down more, goes up to that 50%. If you can make 100% of the move on the upside, you're going to make yourself whole and you're going to be thrilled. So again, if you can't short, won't short, don't know what to do, just make sure that you buy the right dip, which means we're actually going up, not buying a dead cat bounce in a downtrend. All right, so already a lot of information to unpack, which is why I'm going to try to go through a little bit faster now. I've got a lot of slides and a lot of data to get through. So why would we be bullish? Why would we be bearish? The reason why we're bullish is because, again, and I'm going to tell you what my base case is. So again, here's the bullish catalysts, here's the bearish catalysts, and then there's the surprises. I've also bumped up the font because that's what people asked for last weekend. So if you have comments regarding the PowerPoint or the presentation, drop me a comment. This week is very important because if YouTube picks up on the video, more people might hear the message that it is time to be mindful of the risk and understand, if the wheels are in motion, what a bear market actually looks like. So the bullish potential here is that the bottom is in. And let me actually make sure the audio is working because I had a terrible time with this one last time. I just want to take a quick second here to make sure it's working. Perfect. I need this one to work because it is my template for probably the next few months, if not the next few years. Yeah, a few years. So bottom is in. We get a dovish or neutral surprise from Powell. So again, we're looking for a dovish reaction. Maybe he doesn't say anything actually dovish. Dovish just means that he's going to remain accommodative for longer, print money, basically. So if we get a dovish reaction, meaning a dovish surprise, it can mean we could get some relief. Relief is a dead cat bounce. It is a reversal when we take out the relative high. What does that mean? We have to print a higher weekly high. We can't print a higher low and a lower low. That's an inside bar. So remembering that, that's the first potential catalyst. Jerome is going to be on Wednesday. Then we have the earnings reaction. So the earnings reaction could be bullish. Again, whether or not the reports are bullish or bearish, if the reaction is bullish, that could be how we move forward. The reason why is because we would set a February monthly higher low, and then we can go for that higher high. So Jerome speaks on Wednesday, and then we have earnings wrapping up for big tech, meaning the $1 trillion companies, or the FANG MGS, wrapping up on the February 2nd, 3rd. So what would that mean? Into the end of the month, wherever we land, we could set a higher low into February. All right, cool. What is the bearish potential here? The wheels are in motion, and this is a mega long-term trend. I'm talking a decade trend. What does that mean? We've hit the peak of the cycle, and it's time to go down. Don't fight the Fed. The Fed wants to tighten. They're signaling we're at the peak cycle because they're trying to tighten monetary policy, quantitative tightening, raising interest rates. The surprise, geopolitics. I don't think this one's going to flare up. I really hope it doesn't. And the reason why is because of the Olympics. I think that right now the world's going to be watching, and the Olympics kicks off on February 4th, all the way through to February 20th. So what does that mean? The world is watching. And if you want the world to like you, you better make sure when everyone's watching, you're not doing any bad stuff. Easiest way to summarize it. Earnings could be a surprise. Bullish, bearish, neutral? I don't know, but there's a lot of potential. Also, on Wednesday, we have a Fed rate decision. That is the big surprise. That is the biggest driver for this week. And then on Thursday, pre-market. So just if things weren't spicy enough already, on Thursday pre-market, we get GDP Q4 preliminary print. What does that mean? If we have very high inflation and very weak GDP, that is bearish, regardless of what Jerome says and regardless of what the earnings are. Why? It's called a negative real yield. If you have inflation at pretend 7%, interest rates are at 2, if they get to 2, what does that mean? You're guaranteed to lose 5%. People don't like losing money. So that GDP print, it's going to be a quarter of a quarter, and it's going to signal whether or not we are seeing some warning signs that GDP is peaking out. All right, key dates. So now I've got some other key dates here. So again, in January, which means this week as we wrap up, on the 25th is FOMC day 1, and we have Microsoft earnings after the bell. That'll be the next big tech after Netflix. On the 26th, we have the Bank of Canada rate decision. I've added this one in because it happens to be on the same day as the FOMC, which could add as fuel for the bears or for the bulls before the 2 o'clock meeting with the FOMC. And the reason why is because the Bank of Canada is currently forecasting 5 to 6 rate hikes this year. And there's a 75% chance they're going to be hiking on Wednesday. That's going to be at 10 a.m., which means at 10 a.m. or 30 minutes after the market opens, the Bank of Canada might impact the American markets. And then at 2 p.m., Jerome is also up. So there we go. On the 27th pre-market, and sorry, I also forgot. So on Wednesday, FOMC day 2, and then Tesla after the bell for earnings. Tesla is the one company I think has the biggest potential, keyword being potential, to surprise bullish on earnings. And Jerome usually starts talking at about 2:30. That's when the press conference starts. Usually talks for about 60 minutes, which means he'll be wrapping up at 3:30 p.m. And then literally within an hour, 30 minutes to an hour after we hear from Jerome, Tesla will be reporting earnings. So if we're getting that bullish reaction and Tesla also does what we want, boom, we start going higher. If we get a negative reaction and Tesla is also a reaction that's negative, boom, double-edged sword. We could also get a mix of both. One is good, one is bad, and then the net effect or the reaction is what we're going to be tracking. And then if it wasn't already enough, pre-market on the 27th, we have GDP Q4 being reported, and then Apple after the bell. What does that mean? It means between the open on Wednesday and the open on Thursday, there is the most important data we are going to be seeing for a while. The next most important one after that is going to be CPI, the Consumer Price Index. Finally, if we're going to get bearish or bullish continuation into February, what I think is going to drive it is going to be Google, Facebook, and Amazon. So they all report on the 1st, 2nd, and 3rd after the bell. We also have the Olympics beginning on the 4th, and the Olympics end on the 20th. That means for roughly 2 weeks, the world is going to be watching. All right, so now we can see that the earnings are definitely underway. Banks kicked it off, and the reaction for all banks was sour. What's really notable about this is that almost any kind of earnings report is a sell. Beat, sell, raise, sell. Everything's a sell. So that is also a massive warning sign. These earnings reports are liquidity events, and the bears are taking advantage to liquidate their holdings and drill these stocks. So as we look here, we've got Microsoft after the bell on Tuesday, we got Tesla after the bell on Wednesday, and Apple after the bell on Thursday. This is a pretty jam-packed week worth of earnings. Those are not the only companies reporting. There's a lot of big ones here. And what we're going to be looking for is how the market reacts, because there's definitely some chinks in the armor. And the last dominoes to fall are going to be the biggest market cap companies, which impact the market the most. Jeffrey Gundlach in a recent interview said that if you go back to 2019, which means the previous all-time high, and you look at what the S&P 495 have returned between 2019 and 2021, and into the end of 2021, it rhymes with hero. It's zero. The S&P 495 have returned a big donut in the last 2 years. So if these ones start getting sour, if they're able to add that much to the market, meaning 30%, What happens if investors start turning sour on them like they did this last week with a record decline to start off the year? That is the catalyst for us to go lower. The wheels will be in motion, and it will be easier for us to go down than it is to go up. Trying to summarize this a little bit more simply, Netflix earnings, we had a 20 to 25% decline. They beat earnings by like 50%. They had like a 0.00 miss on revenue. They also raised the price of their product, which means they're probably going to do well next quarter. What happened? Negative 20, negative 25%. At the low of the day was roughly negative 25. At the open, it was negative 20. Lost 100 points. And it was incredible. What does this give me an eerily similar thought of? Snapchat earnings. Snapchat had almost the exact same thing. They actually did, Netflix actually did better, I believe. Snapchat beat on earnings, roughly 50%. They missed by like 3%, very slight miss on revenue, 20, 25% decline. Snapchat was the first one to decline too of the growth names. It wasn't the last one. What happened a month later? DocuSign. DocuSign reported about 1 month later. They beat on EPS and on revenue. They guided down. What happened? Negative 43% in a single session at the low of the day. The biggest one-day drop for a quality company that I have seen in an earnings cycle. Negative 30 is extreme. Negative 40, it wasn't overdone though. We're roughly where we were after earnings. And the reason why this matters is because we're only just starting the earnings season. Let's remember that banks kick it off. Big tech is going to be near the front. And then we have all the companies reporting for about a month. What does that mean? At the end of the earnings cycle, we might get those big negative reactions to the rest of the pack. Oh, crap. Yeah, this is potentially quite bearish, and we can't overlook it. So again, history does not repeat itself, but it rhymes. And when I look at this, it's rhyming pretty close. It seems like there's some kind of strategy for to take these things down. I'd also note that just the reaction that we saw to banks and growth names, bank and value stocks like banks, like Goldman Sachs, 6 PE. They did good on earnings. Stock had an 18-month, had its biggest one-day drop in about 18 months. This is Goldman Sachs, single-digit PEs. It's like at five something now, 5.8, 5.9 PE. That is so cheap. Why? They had their biggest earnings year ever. 2021 was their most profitable year ever. What's the market's reaction? Sell it off. So again, we're about 22 minutes in. There's a lot of information so far. If you're enjoying it, please smash that thumbs up and please drop me a comment. What are you resonating with? Does it make sense so far? And what are you noticing that we're going to be doing next week? I'm realizing this is probably going to be a long video too. So I'm going to do as long as I need to make sure my story is out. I don't want to speak too fast because I know people get lost sometimes. And I got a lot more to get through here. Money goes where? So stocks, there's 3 places you can put your money: stocks, bonds, and cash. So the challenge right now is that stocks currently have high risk, which means they have a high PE. So a high price to earnings. Historically, it's quite high. Bonds, you're locking in money for a guaranteed adjusted real loss. What's that called? Negative real yield. In cash, you also have an adjusted real loss. Why? Negative real yield. If inflation or your buying power, inflation goes up by 7% and interest rates are at 2%, that's a gap of 5%. What does it mean? When you go to the store, your $1 now has 93 cents on the dollar in buying power. And if you're being paid 2% bonus, what does that mean? You got 95 cents on the dollar. So you're going to be losing. It's just a matter of where and how. So keeping your money in cash, it's safe, it's liquid, it's not locked up, but you're going to be losing. In bonds, you were locking it up. A 10-year note is locked up for 10 years. You have an adjusted real loss too, based on current real inflation and real interest rates. And then stocks, which is where everyone's been piling in. Why? There's no other game in town. That's the TINA. There is no alternative to U.S. assets. There are now. Cash is an alternative. Bonds are an alternative. Going to emerging markets is an alternative. Going to Europe is an alternative. So what does that mean? The high risk is now coming home to roost. As we noted, again, ARK is down dramatically. It's down like 50% off its high, 20, 30% year to date. That's incredible. So high risk, high reward. Big decline, very sour reaction. It's basically a hangover. All right. Here's a couple more things. So Bloomberg, why am I holding this? Saying bye to Europe's negative yields. Region's negative yielding debt pile is down a third from the peak. Repricing comes as investors brace for tighter monetary policy. Ray Dalio says cash is trash and makes the case for crypto, but warns governments might kill it. This is about like 6 months old or something. So again, he was saying basically cash is trash. Why? There's only 3 options. And stocks were relatively cheap compared to what else you can do for actually being able to keep your buying power. So what does that mean? Are stocks next? Oh God. Oh God. So again, let's go back up to the first slide here and just try to frame this now. So money goes where? It's been largely going into stocks. But year to date, we saw bonds shoot up dramatically. And right now, people are raising cash in a dramatic way. So what does this mean? It means that the stock gains we've been seeing, the money flowing into bonds, it might start unwinding and just get put into cash. Why? People don't know what to do. And it's okay losing 2% a year when the market's going down 1% per day. Oh, that's right. 1% per day. That's like a lot by the end of the year. Yeah, 2%, losing 2 to 5% adjusted real loss by the end of the year seems pretty good when this week we dropped down by 7% on the Nasdaq. All right, so I think what I'm going to do now is actually flip over to so I'm going to take a break here to, I'm going to pick up here in a second, but what I want to do first is actually read this article, because what I think it does is actually frame the bearish potential with the bullish surprise in a clear way, which will take us about 2 minutes to go through and read. And I'm already realizing this is going to be a very long video, maybe an hour and a half. I'm not going to rush myself. I'm going to do as long as I need to. If you're watching after the fact, jump down to the timestamps where you can jump to the relevant section. Nasdaq 100's unrelenting decline ring a dot-com bust alarm bell. Tech-heavy gauge down at least 1% every single day over the week. Perky's at, I don't know if I'm pronouncing that right, at Bespoke views it as ominous signal for the market. Bulls should be glad there were only 4 days this week instead of 5, right? I agree. To wit, the Nasdaq 100 just did something it hasn't done since the aftermath of the internet bubble. To fall more than 1% in every session of a week. It doesn't count as a superlative because Monday was a holiday. But for investors caught up in the sell-off, it felt like something shifted. I felt the shift myself. I've been bearish, but this felt notably different. A full week of big down days hasn't happened since the dot-com bubble burst. First in April of 2000 and then in September 2001. Back then, the Nasdaq went on to fall about 28% before the market bottomed roughly a year later. There you go, right? Bear market 2022, a year later, falling another 28%. Wasn't immediate though. It was first in April of 2000, and then it was like 6 months later, right? Maybe, yeah, 6 months later. 5 months later, right? 4 to 9, 5th month, 9th month. There you go. So it might mean this is the bullish potential too, where maybe we just go sideways for a bit. Why? We've been going up for 2 years, then we go sideways, then we can go down. Oh, that's right. Before we go down, we have to stop going up. We can start going flat, then we can start going down. If you just look at those 2 prior instances, right after 9/11 was a brutal market, while the other was the first leg down in the collapse of the tech bubble, says George Perkys, a strategist at Bespoke Investment Group. It's certainly ominous, isn't it? Yes, because these guys were trading back then. I was not actively trading during the 2000 dot-com boom and bust or during 2001. I just wasn't around. I was young. So looking through here, again, persistent dumping. Nasdaq down at least 1% every day this week and is in a rare occurrence. So why? The Nasdaq 100 tumbled 7.5% this week as what started as an aggressive sell-off in speculative corners spread to the rest of the market. That's where we can note that crypto's already been dropping for months. ARK has already been in decline for months. But now it is spreading, or it is there is contagion to the more bellwether names like Apple, Google, Microsoft, Netflix, Facebook, all those ones. Disappointing results from from sickness darlings like Netflix accentuated investor angst that the economy recovers. Tech growth's edge is disappearing. Why? We're reopening. We need this technology stuff a little bit less. It's not that we don't need it, but if we're not going to grow as fast, growth stocks are probably going to need a hangover. Add to that stretched valuations, and there's just room for a pullback. We already noted what happened with Netflix. It looks ominously similar to what happened with Snapchat during the last earnings cycle. Down almost 12% in January. In a single month, we've entered correction territory. A correction is defined by -10. The Nasdaq 100 is on course for its worst month since the 2008 global financial crisis. On any 4-day basis, the current streak of 1% drops was the first since 2018. 2008, 2018, and 2000. Those are bad years for the market. That's what we're comparing ourselves to right now. Doesn't look good. However, if you would have been warned that in early 2000, the market was going to drop 50% over the course of a couple of years, it would have been a great idea to cut your losses at -10. The last hour selling and the consistent selling each day does seem like institutions are done being patient and rushing to get out, said Chris Murphy, co-head of derivative strategy at Susquehanna International Group, which is what we mentioned earlier before. This is what I've been noticing. The drilling into the close has been consistent. And I'm also going to explain in a little bit the reason why I think that it's been happening in a big way this week. Investors appear to be paying up for near-term hedges as share prices spiral down. The CBOE NDX Volatility Index, a gauge of cost options tied to the Nasdaq, jumped 8 points over the 4 days to 3406, the highest level since last March, which is when we actually had a big violent snapback. Whether this is the start of a bottoming process or something worse is hard to tell. In Bank of America Corp's latest survey of global fund managers, net allocation to the technology sector fell to the lowest level since 2008. Why? They're done being patient and rushing to get out. That's why. Give me 1 second here. I have to sign in to get this thing going here. So let me actually go back to my PowerPoint for 1 second, and then I'll sign in. I don't know why it doesn't have me signed in here. 1 second. I'm sorry for the delay. And if you still haven't, I would really appreciate clicking on that thumb to make the thumb turn blue, because for me, this is something that is very, very important, and I want to make sure the message gets heard. What's going on here? Sorry, 1 second here. I need to get the article up. This is a little bit frustrating. I apologize. I'm trying my best here, right? I'm recording this live and can publish it later, but you know, like, I'm just human. Sometimes I make mistakes. And by the way, too, I really enjoy the Bloomberg website more than any other source for news, just because I think that it's important to understand that there's motivation for other news agencies, notably CNBC, to just put out what people are going to read, meaning clickbait, not necessarily what's the most valuable information. All right, article's almost done here. So whether this is the start of a bottoming process or something worse is hard to tell. Right? Net allocation to the technology sector fell to its lowest since 2008, and we're only down like 12%. It's not that bad yet. Which means that people are not really even net short yet. They're just dumping. They're just selling it. They're trying to do what we mentioned. Sell now, buy the right dip, make all the money back. If there's this kind of liquidation underway here, you have to wonder how much further this could fall, said Perkins at Bespoke. On the other hand, this sort of pervasive negativity in selling is what contrarians look for as a sign sentiment has gotten carried away to the downside. Yeah. So again, that's our bull catalyst for this week. Are we getting too negative too fast? Is Jerome going to be neutral to potentially a dovish reaction? That's the bull catalyst here. However, going back to here now, our stocks next. Well, let's look and see if there's some evidence. Here is the heat map for the last 30 days or the last 1 month. It's pretty obvious to tell what's been getting sold off. Big tech, Microsoft, Google, Facebook, Amazon. all basically down 9 to 16% apiece. Amazon getting smoked. However, what has not fallen yet? Apple, right? Chips are down. Oh God! Now that I look at this too, right? Chips are so chip is leading tech, tech is leading SPY. So chips are already down double digits. $1 trillion ones are approaching double digits, and everything else is a little bit mixed. Why? This is 30 days going all the way back to mid-December when we saw that violent rally into the end of the year, still including part of that. Now we look at the last 7 days. Oh God! Right? Last 5 sessions. Crap! This is looking a lot worse. Those pockets of green are disappearing. Other than ATVI and EA, ATVI having a buyout from Microsoft, everything's red. It's a matter of how red. What's leading the decline again? Chips. Chips are down double digits. $1 trillion companies are down pretty solid too, right? Amazon down double digits, Tesla approaching double digits, Facebook down 7, Google down 6, Apple down 6, Microsoft treading water. So again, we're seeing that, right? They're selling. Fear and greed, we only just flipped back to fear temporarily, right? A little bit of fear. Previous close was neutral. We're basically in neutral territory. It's not really all that bad yet. People don't really feel anxious or nervous. Now we're going to go through a recap of January 9th, when 2 weeks ago, I was calling for the stock market crash. And what I want you to do is put on your thinking cap and ask yourself, is what I'm seeing now a good reflection of what was previewed roughly 2 weeks ago? Meaning, can I now understand what these guys were telling me about 2 weeks ago when I look at the price action? All right, volume's still working. And I really hope this is going properly. Let me just spend one more minute watching it. Perfect. I think it's working properly. This is a great time to remind you to please smash that thumbs up, please, and thank you. And again, these are all from January 9th. You'll note the slides at the bottom have the same kind of template, so it's easier for you to follow along if you're a viewer. Again, please drop me a comment. Are you getting scared yet? Do you appreciate this? And again, just a reminder that what we're looking for is expect the best, prepare for the worst, and be ready for the surprise. So this is not fun for me to put out because I know what happens if we drop this much. It means the world is crumbling. Whatever. And other thing I would note is that this is a global thing. So it's not just one country or one sector, like in 2000 when it was technology in the USA, or 2008 when it was housing in the USA. This is every sector, every country, all at the same time. So it's kind of inevitable we're going to have a hangover. And I mentioned this on the stream earlier this week, but if you spend a night of drinking, the older you get, what happens? The harder it is to recover. Spend a couple hours drinking, go to sleep, wake up, the next day you got a pounding headache. Takes a day or two to recover. This market is late into the cycle. What does that mean? It's an old dog. I'm only 33, and my body's not able to recover as fast as I used to in my 20s. What does that mean? This bull market is getting tired. It is getting old. When it gets a hangover, it's much harder to brush off. Whatever the fundamental and macro considerations, there is no doubt that investors have been selling first and trying to figure out the rest later. Another way of thinking about the tech wreck, at no other point since the bursting of the dot-com bubble have so many companies fallen like this while the index itself was so close to a peak, remembering what Jeffrey Gundlach said. And I shared a great interview with him in the news channel if you want to go watch that. Since 2019, again, the peak, excluding the drawdown that we had in the first quarter of the year to where we are now, 35% is roughly what the S&P's returned before our drop. But if you count the S&P 495, the returns rhyme with hero. It is zero. That's what we're hearing here in the second line. Another way of thinking about the tech wreck, at no other point since the bursting of the dot-com bubble have so many companies fallen like this while the index itself was so close to a peak. Why? The index doesn't care who is rising. It just cares that collectively, on a weighted average, they're going higher than lower. So when 5 names can do the work of another 495, the index doesn't care. The Fed wants higher real yields and has the tools to make that happen. So investors should position for that outcome, wrote a team led by Dennis Deboucher, je m'excuse mon nom, at 22V Research, adding that value, quality, and small size are among factors that should benefit. What does that mean? Don't fight the Fed. The Fed's telling you We're changing the monetary policy of the last 2 years. The punch bowl is getting pulled away. The market is a future discount mechanism as well. So what's it doing? It's discounting the future environment, which is going to be getting tightened. It's not going to be accommodative anymore. Valuations are at a historical highs. Companies are raising billions based on fairy dust, and the risk and the Fed is signaling a tightening cycle. All of these are scaring investors that we're on the cusp of a repeat of 1999 to 2000. Yep. All right. The question looming on investors' minds, can tech earnings weather further rate shocks should the 10-year treasury yield rise to 2%, as many predict? While it's not an exact science, a simple math exercise shows profits from the Nasdaq 100 firms would need to climb 10% for the benchmark's price to stay where it is and maintain its current valuation relationship with bonds. That might be a high hurdle to clear. Analysts expect software and internet companies to report a 5.9% increase in 2022 profits. Data compiled by Bloomberg Intelligence show. I'm actually really curious what's Netflix's earnings were now. Why? Because it was more. I want to actually look at this now because I know they grew earnings by quite a bit. Sorry for the delay. I think it's important that I take a quick second here to just reflect this. And again, it's not an exact science, but I just want to show you that these things matter. So here we go. So just reading this, right? Nasdaq 100 firms have to climb, would need to climb 10%. Sorry. Would need to climb 9% from the benchmark's price to stay where they are to maintain the relationship. And again, company need to report a 5.9% increase in 2022. 60% beat, 0.00 miss on revenue. What does that mean? In terms of earnings, not profit. It's basically the same thing though. 60% beat. That's for 2021. So they beat by 60. That is 10 times more than what is needed to just maintain the existing relationship. So why does that matter? Because the reason why Netflix went down is because they're showing signs of slowing subscriber growth. For a growth company like Netflix, that's what really drives the stock. So when we read here again, Netflix shares fall 20% on slowing subscriber growth. Why? Because for 2022, they're going to have less money than 2021. So it's great what you did in 2021. You crushed it. But into next year, that's where there might be a hangover. So if Netflix beating by a factor of 10 is not enough, it gets a haircut of 20-25%. What's going to happen to these other companies? Microsoft and Apple are expecting like a 3 to 5% beat. That's not very high at all. As a result, the Nasdaq 100 earnings yield, a measure of profits relative to share prices, has been whittled down to 0.85 percentage points above the 10-year treasury rate, the smallest advantage since October of 2018. Sign of the top two is that retail is diving in head first. So nearly 18 billion is flooded into equity, into ETFs over the past week. That is year to date. And QQQ saw outflows of 700 million. And now we're seeing that accelerate. Why? Lowest holding of tech stocks for fund managers going back to 2008. So let's just frame this for 1 second here. Let's go back to here. So again, at no point has the differential been lower since October of 2018. 2 months later, December 2018. And what happened? Boom, negative 10%. So did we already get our drop? Is this going to happen into March when we actually see that quantitative easing is done? Meaning that they've finished the tightening, and they're also going to be signaling rate hikes? The taper, right? Taper should be done in end of March, 2 months later. All right, at 44 minutes, another reminder to please smash that thumbs up and drop me a comment. I would really appreciate it. Take a second to pause the video. I'm taking a lot of time to present this to you, and I would really appreciate your support. My own view is that the Fed and the market are still not recognizing what's likely to be necessary. Summers said on Bloomberg Television's Wall Street Week with David Weston. The market's judgment and the Fed's judgment is that you can somehow contain this inflation without ever rising above 2.5% in terms of the Fed funds rate. If you want to know more about Larry Summers or my viewpoint on that, please watch the weekend from 2 weeks ago. We will leave a link to that in the description if you want to go back and watch that after. All right. Larry Summers used to be the Treasury Secretary during the dot-com boom and bust. That's who this guy is. He matters. He matters. He matters. The challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets and concern about growth before they see the declines in inflation that are substantial. Let's read that one more time. And this is from January 9th, by the way, 2 weeks ago. What's happening now? The market's finally picking up on it. The challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets and concern about growth before the declines in inflation that are substantial. What are we getting on Thursday? GDP. That is literally growth. And what's a financial market? The stock market. Oh, crap. Then they're going to have a very difficult set of decisions to make, Summers said. We're heading into a very challenging period for the Fed in terms of executing a soft landing. What's a soft landing? We'll get to that in a little bit. Summers, a Harvard University professor and paid contributor to Bloomberg, said that if inflation did come down without the Fed hiking its target rate past 2.5%, that would only be likely if the U.S. economy had proved unable to cope with tightening of a lesser scale. What we're going to find out is what the vulnerability of the economy is to rate increases, Summers said. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. Here's where it starts to get a little bit more advanced, and I encourage you to just keep an open mind, and I will make sure that I guide you through to tell you the stories. So again, what we're looking at here is Larry Summers used to be the guy who was in charge of the money in 2000. He's telling us that if inflation did come down without the Fed hiking the target rate past 2.5%, it would basically only be because the U.S. economy can't handle it. And because there is a greater level of debt and asset prices are inflated, the economy is vulnerable to rising interest rates or quantitative tightening, meaning reverse liquidity. Keep that 2.5 number in mind here. Why? This is a new section from last week. It is the hawks. What is this? It's the Fed's narrative that I am seeing being forecasted. A hawk means bad for stocks, to make it simple. A dove, right? Not much of a threat. A dove is cool, right? Never comes to attack you. A hawk, he's the king of the sky. The USA, in terms of the Fed funds rate, which is what Larry Summers was talking about. If we look here, again, 2.5% is where we peaked out during the last cycle into 2018. And what happened? The market buckled. We had that drawdown in 2018 where Jerome Powell was in charge of the Fed. So what do we have here? We're chartists, right? We're technical analysts. We should know what this means. High, lower high, lower high, lower high, lower high, lower high. What does that mean? The market was only able to every time we put a lower high in relative to the interest rate, it means the economy can't handle the previous level of inflation. Why? Levels of indebtedness and, right? Let's go back to just what he said. I'm not smart enough to remember it. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases and quantitative tightening. It's been happening for the last 30 years. So why would this time be different? Every time the Fed starts to get hawkish, it's less and less and less and less before the market says, it's too much. Stop. Why does this matter? The Fed's telling us 2.5 is where they see us peaking out. FOMC members' dot projections for the meeting dated December 15th of 2021. Where's that green line in 2025 and longer term? It's at 2.5%. What are they saying? We can't get above 2.5%. Why does that matter? Boom. Double top. It's not going to make a higher high. It's going to make a double top over the course of the next couple of years. We're in 2022. Go to 1, go to 1.5, go to 2, then 2.5. That's all we can handle. That's what it's basically saying. That's what the Fed's confirming. We're not going to put in a higher high. Let's go back and read this for one more second here. Larry Summers is telling us. Summers, again, if inflation did come down without the Fed hiking its target rate past 2.5, that would only be likely if the US economy had proved unable to cope with tightening of a lesser scale. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. Ask yourself, when you look around the world, look in America, are people more in debt or less in debt? We've been talking about this extensively, so I don't want to beat this drum again, but we know that 4 out of 10 Americans could not afford a $1,000 emergency expense before 2019. And now, 2 weeks ago, we noted that credit card consumption or credit card usage and non-revolving loans is hitting a record level of 40 billion. What does that mean? People are broke. And it signals that we're probably not going to get to 2.5. Jeffrey Gundlach from Double Line only thinks we're going to get 4 rate hikes before the market buckles. That's 1%, not 2.5, not 2, not 1.5, 1%. So what does that mean? The Fed is nearing the end game. Why? I did a lot of research this weekend. In future videos, I will continue to tell the story, but because it's already a 15-minute video, I decided to just take the stuff that's most important here. Look at Japan. 1975, 1980, 1990, 2008. What is it? Lower highs. Where's Japan now? They're not the country they used to be. They're so indebted right now. Japan's the template. It's important to note, too, that quantitative easing was birthed by Japan. Right? They're the ones who started QE, bond buying. They also have something called the stock fund, where the Japan bank has been buying the Nikkei for about the last 10 years. The Fed is currently not allowed to do that. They're not allowed to buy stocks. They're only allowed to buy bonds, which means they can support public companies like Boeing. Boeing had a $5 billion debt offering, like in 2020, and was held by the Fed. Fed put in part of the money. What does that mean? Boeing got money, but it was through a debt agreement. It wasn't through actually getting equity or stock. That's what stock is. It's equity. So Japan is our template. And 30 years later, boom and bust. Here's a recap again and a reminder. The Fed wants higher real yields and has the tools to make that happen. So investors should position for that outcome. So this is from Ray Dalio, and I have to say that I have learned a lot from Ray Dalio. I really respect this man. I really respect Jeffrey Gundlach too. These guys are usually early, and again, been hearing about this for years. So how to deleverage, meaning how can what Larry Summers is talking about is a soft landing. So a soft landing means that the average person does not really get a huge hangover. The stock markets don't collapse or housing price doesn't collapse. There's 4 ways to deleverage a debt cycle. What is it? Cut spending, reduce debt, redistribute wealth, and print money. Ask yourself, how many of these are we currently doing in the US? We're definitely cutting spending, right? That's belt tightening. It's harder to do, though. People don't like tightening the belt, spending less. Reduce debt. What are we hearing about with student loan debt right now? People can't pay it back. So there's going to be debt forgiveness. Reduce the debt. Give it a nice little haircut. Redistribute wealth. What are they literally talking about right now? Taking money from the rich and giving it to the poor. That is redistributing wealth. Printing money. Oh, baby, we've been printing like crazy. So we're already trying to deleverage, whether you're aware of it or not. There are 2 tools. And by the way, these are screenshots from a video called "How the Economic Machine Works" from Ray Dalio. I will leave a link to that video in the description. It's honestly probably one of the best things you can read. It's a 30-minute video, and it will help you understand how the economy actually works. It's like a machine. So if you understand how the machine works, and if it starts to show you some warning signs, like when you're driving in your car, when you hear a rattling and it goes, you're like, oh, my car's fine. I'm not going to go get it checked out. You take it in for an oil change, you get it inspected. So it's the same thing here. If you're aware of how the economic machine works and it starts making those noises, you don't ignore it. You look at it as soon as possible and try to fix it. So right now, the central bank has 2 tools. The first tool is interest rates. They can raise them or they can lower them. The second one is printing. Again, printing money is quantitative easing. That's liquidity, a liquidity-driven rally. So quantitative tightening is reverse printing, where they're now taking money out of the system. Raising interest rates is when they make it harder to borrow. They're planning on doing both at the same time. And I think I know the reason why. So these two tools are what really matter. And in December, the FOMC, or the Federal Open Market Committee, collectively told us that we're planning on raising. And since we're in a blackout period for the Fed right now, all of them, including Dowley, Williams, who else? Brainerd, right? All the doves, they've been turning into hawks, saying it's time to raise rates. It's time to take the liquidity away. So what does that mean? It means this. So the parallels here are very similar. And again, this might be a little bit complicated for you. The easiest thing to look at will probably be the next slide here. Let's look at this next one first here. So Fed balance sheet and S&P 500 stock returns. So just look at the chart. It's hard to argue that there is not correlation between them both. When the orange line, the Fed's balance sheet, right, goes up, the blue line goes up too. That's the S&P 500. So Fed's balance sheet expands, stock market goes up. All right, balance sheet starts to flatten out, market crashes, flattens out more, crashes big time. And then when they start printing, look at that straight line up and the continuation, boom, 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 boom. That's the stock market going higher. So now we can go back to here, and I understand the reason why they want to signal they want to tighten. Why? We're near the end game. We're very late cycle. So the Fed's balance sheet, when we look back to the 2008, and let's just look at this one more second. Let's go back to a previous slide, because the importance here is just you're hopefully you're connecting some dots here, and this might be a little bit sobering, where we've been partying for a long time, and now you're like, oh God, this guy wants me to sober up. Yeah. So 2008, and then we're in 2018. So again, lower high, lower high. So we're going to jump forward now, and let's look at the next slide we were looking at. This one here. So again, what happened in 2008? Well, again, it was bad, and they printed. So same thing we did now. Print, 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 print. And now what we're noticing is that, again, Nike swoosh, and this is not a log scale, which means that as the number gets bigger, the lines look bigger. But what I did is some math, and I note here that the peak off the initial printing to the relative new high is about 2.5 years later, and about 25% higher high. 2.8 trillion divided by 2.2 trillion roughly. Then we look over here, Nike swoosh, and then the continuation higher, right? There's the expansion of the balance sheet through quantitative easing. Then we look over here, 2 years, 25% higher high, 8.9 trillion divided by 7.1, 2.2 years. So what does that mean? We're roughly tracking. So they're going to try to repeat what happened here. We had taper tantrum. They weren't able to actually lower the balance sheet. They could just level it off. Stock market crashed though. Why? Look, right? They just start to tighten a little bit. They tighten a little bit more. They're telling us right now, we're doing the same thing. That's what they're signaling. We're going to make this line go down. What should happen? Ask yourself for a second, what should happen? Is history repeating itself? I think so. So now, something we can try to talk about here that's also in the video from Ray Dalio, how the economic machine works, is what is a beautiful deleveraging? A beautiful deleveraging is when we're at the end of the cycle, but we don't want to have that nasty hangover. If you're drinking, if you have a night of drinking, there's a few things you can do to avoid that hangover the next day. Have a glass of water. I'm talking a few glasses of water. Eat something so your stomach's not empty. But if you just go to sleep and you pass out, you're going to wake up and feeling really, really bad. So let's read this one more time here. Again, I'm repeating the slide from before. The challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets and concern about growth before they see the declines in inflation that are substantial. We're heading into a very challenging period for the Fed in terms of executing a soft landing. What is a soft landing? A soft landing is that beautiful deleveraging. I highly, highly, highly encourage you to watch that video from Ray Dalio. It's only 30 minutes, and it will help a lot with the context of what I'm trying to lay out here. A soft landing is a beautiful deleveraging. How do we deleverage? Again, we can cut spending, we can reduce debt, we can redistribute wealth, or we can print money. So what's going to really matter is the messaging from the Fed when they meet on Wednesday to tell us what they're going to do. So it's really important. Why? If we're going to stop printing and we're redistributing wealth, one of these is going to have to happen. More, all of them, ideally. It's a balance. It's a fine balance between all of them. So we're going to have to find what that fine balance is and what breaks the system. So again, for us, The reason why this matters is because money generally flocks into three buckets: stocks, bonds, or cash. So again, a stock is ownership in a public company. You own part of the company. A bond is a debt. It's debt. It's like you're writing a loan and the company is borrowing from you. So you say, hey, I got $100 to borrow. The company is like, hey, I'd love to borrow that $100. We'll pay you 2%. So we're going to pay you $102 in the first year, $102 in the second year, right? We're going to pay you back $2 extra. A 10-year note, roughly at 2%, means that over the course of 10 years, for every $100, you'll get paid $2. You don't own the company, though. All you have is a loan. A stock means you own the company. Cash means it's liquid. You can use it for anything. So that's where money goes. And what the Fed signals and where the money flows is basically telling you where we're going to go. I would also note that what Jerome Powell is trying to do, he is trying to execute that soft landing. I don't know if he's going to be able to do it. He's trying, right? And he thinks that if the 210s don't invert, that signals no recession. That's not how the economy works. The economy could care less about what the, again, it's not that it couldn't care less. It's that it's not an absolute guarantee that if the 2s, 10s don't invert, that we're not going to get a recession. It's a leading indicator. It's not a preventative measure. So again, repeating these from before. Why am I holding on to this? Saying bye to Europe's negative yields. Why? Cash seems like a much better proposition right now than holding on to something that is locked up for a guaranteed loss. If I'm going to lose, don't lock it up. Region's negative yielding debt pile is down by 1/3 from the peak. Why? We're starting to tighten. So this is called a reach for yield. When you have more cash on hand than you know what to do with, you would rather put it into riskier assets and get something back than to get nothing. That is now changing. People are getting defensive. Ray Dalio says cash is trash and makes the case for crypto, but warns the government might kill it. We heard from Jerome Powell that right, the private coins can coexist with the Fed coin. And now Joe Biden is saying that in February, we're going to announce something for policy on a digital coin. This is from a few months ago. And again, I don't think cash is trash. I'm just making the point here that we're now seeing that people are saying that every asset class is just not what it used to be. So are stocks next? Crap. The last hour selling and the consistent selling each day does seem like institutions are done being patient and rushing to get out. Oh, that does seem like what it was. If you don't understand what's been happening, this is a really good way to summarize it. All right. So again, since we're talking about the Hawks, the big thing here is, who is Paul Volcker? Paul Volcker is the person who was in charge of the Feds in the late 1980s. So President Nixon had contributed to inflation by ending the gold standard in 1973. However, we're going to jump down to the next highlighted section here. Fed Chair Alfred Hayes tried to fight inflation and recession at the same time as he alternatively raised and lowered interest rates. That is exactly what Jerome Powell did. Since 2018 till today, he hiked, he lowered, and now we're confused. His stop-go monetary policy confused consumers and businesses. Worried companies just raised prices to stay ahead of the future high interest rates. Consumers kept buying before prices rose even more. The Fed lost credibility and inflation rose to double digits. It happened in the 1980s. History does not repeat itself, but it rhymes. So just take a second here to pause and ask yourself, right? Fight inflation and recession at the same time. That is exactly what Jerome's trying to do. Alternatively raised and lowered interest rates. His stop-go monetary policy confused consumers and businesses. Worried companies just raised prices to stay ahead of future high interest rates. Consumers kept buying before prices rose even more. The Fed lost credibility and inflation rose to double digits. Thanks to Volcker, central banks realized the importance of managing inflation expectations. As long as people thought prices would keep rising, they had the incentive to spend now. The added demand drove inflation even higher. Consumers stopped spending when they realized Volcker would end inflation. Businesses stopped raising prices for the same reason. Let's zero in on one sentence here now. The Fed lost credibility and inflation rose to double digits. So isn't that what's happening right now? It's not just this, it's also the supply chain. So the supply chain is causing people to buy, right? To buy before they need to. Consumers kept buying before prices rose even more. The problem is exacerbating. It is not getting better. And I think the challenge here as well is that the Fed's been battling disinflation for the last decade. So like, we want inflation. They don't want to say that, but like, we want inflation. But now be careful what you wish for. So this is from 2 weeks ago too. Henry Kaufman, again, the guy who used to work at Solomon, right? Dr. Doom. 1970s Wall Street, Dr. Doom blasts Powell on inflation. Kaufman questions Fed's chair's stamina to tame prices. Former Solomon chief economist urges immediate rate increases. What do we have on Wednesday? An FOMC meeting. What are we going to be hearing? We're going to be hearing from Jerome and the FOMC. So the question is Jerome actually ready to do what is necessary to maintain Fed credibility, get inflation in check, and manage inflation expectations? When you start saying inflation is transitory, what you're saying is that some higher levels of inflation are tolerable. No amount of inflation should be tolerable above 2%. That is what we're seeing here. And again, just read this again. Thanks to consumers kept buying before prices even rose. The Fed lost credibility and inflation rose to double digits. We're starting to repeat 1980s. Thanks to Volcker, central bankers realized the importance of managing inflation expectations. As long as people thought prices would keep rising, they had the incentive to spend now. Isn't that what everyone's been doing, even into Christmas? Not because of the Fed, though, because of the supply chain. The added demand drove inflation even higher. Consumers stopped spending when they realized Volcker would end inflation. Right now, there's no thought of that. Okay, so if this is true, what comes next? Dalio's Bridgewater warns of possible lost decade for stocks. A lost decade means no gains for 10 years. Profit margins for U.S. companies may be at risk in long term. Level of corporate debt set to rise because of the sickness. What did we talk about when Larry Summers was talking, right? Higher levels of indebtedness are going to have an issue. We're also talking about Japan. Just Google Japan 1990s debt crisis. It's called the lost decade. It's now turned into the lost decades. 1990 to 2000, 2000 to 2010, 2010 to 2020. 30 years. 30 years. Lost decades with an S. So Ray Dalio is usually right. He's usually early. So the big question is now, we talked about that 2.5% inflation rate, and the Fed's already done all of its printing. So again, this is from the How the Economic Machine Works video. And what it shows here is that if debt is rising, again, interest, right? Interest rates are expected to go to 2.5%. At the same time, they're removing accommodation, which means your buying power or your credit worthiness is going to diminish. What does that mean? The Fed is doing exactly what they shouldn't be doing. They're tightening at the worst time. People's ability to make money is saddled with debt. So it's going to be even worse. Level of corporate debt set to rise. Profit margins are going to shrink. What does that mean? Right now, the scale is leveled off. It's credit worthiness for the U.S. economy. It's going to tilt into this favor, not credit worthy. Too much debt, not enough money. That's the problem. Again, highly encourage you to watch the video. So, well, what's next? The wheels are in motion. The wheels are in motion. So if this is the start and not the end, and now we're seeing that there's a secondary leg lower here on Bitcoin, I don't know exactly where we are. As I'm recording this, we're at 35,000. So a little bit higher than we were here at 34,000. Not dramatically higher, though. This is the most sobering chart I'm going to show you next. Late 1980s, we expand for 149 months, 600%. Peak out in 2000. What is this period right here? This is a log scale, by the way, which means we're looking at percentages and not points, which means it's easier for us to see the pattern. 2000 to 2010. 2010 to 2000 to 2008. 2008 to 2013. All right, 149 divided by 12. That's 12 years. That's a lost decade. Make money, 600%, lose half your money once, 50% cut, rally back up, double top, lose half your money again, get your money back for the second time, then it goes higher. That's a lost decade. What do we have setting up in 2008 till now? 154-month expansion, 600% gains. We rocked that 50 MA until we don't. We haven't even tested it yet. That's 100 points, 1,000 points lower, by the way. It's pretty sobering, isn't it? Bounce, 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 lose it. Bounce, 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 lose it. Also, just quickly looking here again, we get roughly 1, 2, 3, 4, 5, 5 cuts before we top out. Here we got roughly 1, 2, 3, 4, 5 top out. 5 and 5, 600, 600, same amount of time, same kind of fundamental backdrop. Very hard to ignore the technicals. Very, very hard. Very hard to ignore the technicals here. So I waited to show this slide until about an hour in because this is the scariest chart. What this means is that potentially between now and the next decade, if not more, this could be the end game for the US being the reserve currency. What does that mean? It doesn't mean everything's going to end. Japan was never the reserve currency. 30 years later, they're still a G7 country or one of the 7 most powerful countries in the world, but they're not one of the top. Why does that matter? Because right now, the US is still the reserve currency. And these cycles repeat over the course of years, if not decades. So again, this, in my opinion, is the worst case scenario. I hope to God that I am wrong. And if I am, please make sure to drop me a comment and tell me. If not, smash a thumbs up and just drop me a comment and give me some support, please. This is really years in the making for me to put this video together and to package it up. It's only been an hour and 10 minutes so far to make you understand. I'm not trying to just say, here's the chart we're going to drop. I need to give you the context. There's still more context for us to go through. So again, if we're starting to decline, this could potentially just be the start of it. And where does it end? 50% haircut. Where is that? 4,800 divided by 2. Basically 2,400. Testing the 200 MA. What happened here on the first wave? Right? Five dips and then lose the 50, go down to roughly the 200. What are we here at right now? 2,000. That's the number right here. 1993.88. So this is going to slowly curl up like it did here. And a 50% drop from 4,800. 4,808 times 0.5. We get a number of 2,404. So if this black line here curls up, where's my cursor? Where's my mouse? Okay, here we go. So hopefully you can see my mouse here. So what we can notice that once we lose the 50 MA here, we go down to roughly the 200. This will slowly curl up over time. And this made it to the 90th percentile or 90% of the way between the high and hitting the 50 MA. That's our low here. 50, like it's a 45, 48% correction. This one here is 54%. So if we do drop here and we're roughly 2,000, it's gonna curl up quite slowly. So what that means is that if we were to drop by 50 when the end of this decline is done, would be at roughly 2,400, sorry, and we would be above that black line. Dead cat bounce all the way back up, and then we go for the bigger cut in the lower low, below the 200 MA. What happened here? Volcker fixed the system. Boom, massive expansion. Then what happened? Dot-com boom and bust. One sector, one country. Technology stocks in the United States down by half. Everyone loses half their money. Now we rally back up. 2008. What happens here? Double top. What was it again? Housing in the United States. One sector, one country took down the Western world. Boom, 50%, 54% drop. What's happening now? Every country, every sector, unanimously, synchronized, all having the exact same issue that has lasted for years. This one here, the reason why the cut is so nasty is because once they realize there is the problem, they rip the Band-Aid off. We have been doing the exact opposite. We've been going la 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 la. This time's different. We're singing Kumbaya. We can't go down. We've never gone down. Every year we go up. Yeah, because again, look here, for 154 months or for more than 10 years, roughly 12, 13 years, every dip's been getting bought. And that's what people have been trained. I was not trading markets substantially during 2008. I dipped my toes in 2005 and 6, and I blew up before 2008, which means I wasn't trading. Yeah, I started trading in roughly 2005, 2006. I didn't even know what was happening in the world. I was like, whoa, I'm just seeing headlines of like, yeah, everything's like falling apart. So at least during the bulk of my trading career, it's been moves higher. So every dip's been getting bought. And that's been the mantra: buy the dip, buy the dip, buy the dip. Well, buy the dip works until it doesn't. So again, remembering that first slide with a key takeaway. If you can avoid this 50% correction and not tempt yourself to get in, when we do go back up, because the US is still the superpower, you will make all the money back, more than you want. And you can do it multiple times. So if people, again, let's pretend right now, to make it nice and simple, you got $10,000 in your account. It goes from being worth about 10,000 today, whether or not you made money. Let's pretend we're right here, right? First candle down, it's about right here. You got $10,000, it goes down to 5. It goes back up to 10, goes down to 4,500, comes back up to 10. You basically get your money back about 12 years later, but then there's this stupid thing called inflation, where you have $10,000, but $10,000 does not buy you what it did 12 years ago. You lose buying power. You get your $10,000 back, but it doesn't buy you as much as it could before. A $10,000 car that you could buy in the 2000s is not going to get you the same kind of car 12 years later. What does that mean? You got taxed. You just don't know it. That same thing is likely setting up here. All right, scary enough. Let's move forward. It's an hour and 15 minutes too. Please smash a thumbs up. Please drop me a comment. Would really appreciate this. And this is going to be my template for going forward too. So, right, I mentioned it last week. These bears are cute. They look nice until they come for you. So a bear's got to eat too. And bears have been in hibernation for a long time. This guy's cute until he isn't. How many slides do I have left here? All right, it's getting closer to the end here. So I can start going probably through a little bit faster, probably have about another 10, 15 minutes. And this is where we're going to start going through what we normally do on these weekend videos. So getting a lot closer here. And again, you're probably sobering up pretty fast here, huh? Oh God, I've been drinking hard. Yeah, I'm drinking coffee here, right? I'm not drinking anything strong. But hopefully I'm doing a good job to craft the narrative and to help you understand what's happening. And like I said, I have not laid this specific video out until I actually had evidence that we are currently dropping. Not just that there's potential. Why? There's been potential for the last 2 years. There's been potential for the last 10 years. But now the wheels are in motion and everyone's singing the same tune. However, a lot of people don't see the story yet. Look at the fear and greed index. Look at the percent declines. We're only just starting. And these institutions, they cannot dump shares fast enough. Why? They've got tens of billions, if not hundreds of billions to sell. And there's just not that much liquidity in the open market. So when we get to the Goldman Sachs section a little bit later here, I'll tell you the reason why I think that they're doing this strategically. So if we're going to go into a bear market, these are targets I would be looking for, and not all necessarily in 2022. You'll also note I'm only going to a 30% drop because that's scary enough. That is scary enough. We don't have to talk about going down to 200s yet, right? Once we get to 300s, then we'll talk about 200s. So right now, Tex is big. You should be able to pause the video and watch this. 440s, 430s, 400, 480s, and 330s. The numbers that are red are the most important ones. 10% drop, 20% drop, 30% drop. So to drop down by 20% from the all-time high at 479.9 on SPY or 4808 on SPX, we're looking at roughly 384 on SPY. 100 points off the all-time high. Why? Roughly 500 points, take off 20%, roughly 100 points. That's basically Netflix. Take off 100 points. From where we are right now, I think we're at about 437, something like that, as the cash close on Friday, which means that we've now filled that first gap on SPY, 436. So going back up to 440, December low. So now we're below the December low. What does that mean? We got a lower low on the monthly. We're now at 441. We are below the 200 DMA. We're below the long-term price on the daily chart, and we're printing a lower low on the monthly. That's the start of a bear trend. Multiple months of lower highs and lower lows. There's your confirmation. 430s, 436 gap, 434 is our 50 weekly moving average, our short-term price for a weekly time frame. Very important. 432 is a 10% drop. Also perfectly corresponds with that base on the BTC ES chart we looked at, 432. That was the launch pad before we went higher. Actually, one more thing I want to look at here too, just since I'm forgetting, what I've been hearing a lot from the bulls is that we didn't get the beautiful, sexy, enthusiastic blow off top that everyone was thinking we're going to get. 600% over 10 years, baby, you got your blow off top. The S&P 5 delivered 35% to the index. The S&P 495 delivered nothing. So just like when Bitcoin was at about 26,000 and I wanted 20, it got close enough, but not quite where you wanted it. And the bulls who are going to be stubborn and remain long are likely going to be wrong. They're likely going to be saying that this dip's for buying. We didn't get the blow off top yet because they're too zoomed in. They're so zoomed in, they don't zoom out and realize that this is the long-term cycle. Again, if you watch the Ray Dalio video, there's a short-term debt cycle and a long-term debt cycle. So inside of the long-term debt cycle, there are micro moves inside of the macro move. What does that mean? You're probably getting confused. So all it means is that we are in a long curve, right? Hundreds of years, 100 years plus for the US, and 10 years into this bull expansion, 600%. So what's happened in the last 1 year is a micro move inside of the macro. Micro means small, macro means big. Long-term cycle, short-term cycle. So in the short-term cycle, maybe people didn't get the blow off top they wanted, but look at this chart and tell me I'm wrong. Look at the snapback. Look at the drop right there. Boom, slingshot up. Drop right there. Boom, slingshot up. There's your blow off top. There it is right there. And crypto just took more juice than would have normally gone to the stock market. Why? Crypto was worth about $2 trillion. That's worth about 10% of the US equity market. So it just means that there were more ways to inflate or to blow off. Look at the Bitcoin chart and tell me that that's not a blow off top. So remembering that there's more asset classes people can buy now. They can't just buy stocks. They can also buy crypto. So a blow off top would be defined by asset classes just showing some kind of similarities. History does not repeat itself, but it rhymes. So going back to these numbers now, I hope you're hearing what I'm saying. If you are, again, smash a thumbs up, drop me a comment. I keep repeating myself because I want to make sure I drill this into your head. Don't be blindly bullish, right? See no evil, hear no evil, speak no evil. If it starts to show you what you need to see to know we're bearish, and we're only going sideways right now because we're still above the 50 MA, staircase up, elevator down. When we start taking the elevator down like crypto did, people are only now realizing when we're down by 50 that might be it. Half your money's gone. Don't wait that long. There's a lot more I can talk about. I'll bring this in future videos. I just got to think about it. It's already been an hour and 25 minutes. I got to be a little bit faster now. What time is it here too? What's the time? 8:47. Oh, crap. It's getting late. All right, 430. So next target would be the 432 10% drop. Then we got the 400s where we have another gap going back to Joe Biden's election night. 400 psychological and a gap. So that would take us between a 10 and 20% drop. The last time we had a 10+% drop was in September, I believe, of 2021 or March or what. I forget. So it's sometime in 2021. I think it was in September. Or maybe September 2020. I forget. 10% drawdown. It was like a 13% drawdown. So our drawdowns have generally been between 10 and 20%, roughly about 14, 15%. So if we go down to 400 and we don't go below 400 and we bounce off there, 400 is the area you don't want to make sure we re-penetrate. Going below 400 and losing it would be the same thing as going below the 200 DMA, dead cat bouncing up, and then rejecting off the 200 DMA. If we can't hold 400, we're going lower, potentially 100 points lower, if not more. 380s is where I would expect at least a dead cat bounce at 384. And then in the 330s, we've got a lot of support here. 339 is the 2020 all-time high. 336 is a 30% drop. 334 is our 200 weekly moving average. And 330 is our 500 monthly moving average. 330 is rock solid support for a dead cat bounce and the potential for a reversal. So where is that? It's 100 points lower. As a reminder, we have an algo that tells you when we're bottoming. So if we're going to really bottom and we're going to really reverse, our system will pick it up. I'm very positive on that. I've done the back testing. It worked in 2000, worked in 2008, worked in 2018. So it's going to give us the clues, but then it's on us to validate and make sure this is actually the right dip to buy, the right one, not the convenient one. Okay, so here is where I think Goldman Sachs might be losing control of the market. I'm going to show a few things to try to show you that the wheels are in motion and it might be hard to put the train back on the track. So last Sunday, Goldman Sachs now expects 4 Fed hikes, sees faster runoff into 2022. What are they getting? They're trying to cuck everyone. On Sunday night, a Sunday afternoon when the market's closed, futures aren't open, they're like, we know what we can do. We talk, people listen. So they said, we now expect 4 rate hikes and see faster runoff in 2022. This is bearish. And what happened? Gapped down. However, by Thursday, what they're saying is that worried about a bubble, why you should overweight U.S. equities this year, according to Goldman Sachs. Valuations alone aren't a reliable signal to get out of equities. Cautions the CIO of Goldman's Consumer and Wealth Management Division. He's basically telling you get bearish. Now we look at what happened on the chart last week. Doji in an uptrend. Red doji. The chart is telling us data. Fundamentally, we got new data. Technically, we see the reaction. So what is a red doji in an uptrend? Is Goldman Sachs losing their edge? That's the question here. So again, on Sunday night, they create the dip when the market's closed. On Monday morning, we gap down. On Monday to Thursday, they're in there buying that dip. On Thursday, they tell us that remain overweight in 2022. On Friday, the weekly closes higher than it opened. And then what happened the following week, or what we just wrapped up, OPEX. So why would Goldman Sachs, on the week before monthly OPEX, when there's all these bearish puts, try to create this narrative? Create the dip, gap it down, buy the dip, tell everyone to remain overweight in 2022. Friday, we closed lower than we opened. Following week, we got a monthly OPEX. I shouldn't even have to tell you. You should understand. They were trying to scrape the chain, and they were in there buying the dip. And then what happened? The institution said, thanks for liquidity. Very much appreciate you. So they're trying to fix the chain. The last hour selling and the consistent selling each day does seem like institutions are done being patient and rushing to get out, said Chris Murphy, co-head of derivative strategy at Susquehanna. 3 out of 4 days this week, we had options expiry. Friday being the big one. Friday, we had a climax in volume. So what does this mean? Goldman Sachs has exposure. So they're going to have to at least attempt to buy the dip to not pay out the puts. What does that mean? That is the perfect opportunity for institutions to be dumping. These guys have to at least try to prop it up. Let's take advantage of the liquidity and let's just drill this thing. 3 out of 4 days. They have to at least try to plunge. What does that mean? They're buying. And they bought last week before. So Goldman Sachs, the earnings reaction. What happened? Goldman Sachs lost $500 million trading stocks in Q4 as it quietly sold even more billions in equities. So not to try to over mansplain this, but what it tells me is that Goldman Sachs needed to attempt to at least try to salvage what was going to happen on monthly OPEX on January. Why? A lot of money in exposure. Trillions of dollars usually expire in terms of premium and single stocks, right? Indexes, all that stuff. It's not even quad witching. It's just monthly OPEX. So they don't want to lose more. They're tired of losing of hundreds of millions of dollars. After a stellar Q2, in which Goldman saw a record $5 billion, in Q3, they lost $820 million. And then they lost another $500 million in Q4. That's a $1.3 billion loss in half a year. According to Goldman's investor presentation for the second quarter in a row, equity investments net revenues reflected significant net losses from investment in public companies, equities, compared with significant net gains in Q4 of 2020. And we talked about, like the previous slide showed that they've also been even selling more billions in equities. So what does that mean? Before, we were getting upside volatility where people are buying calls, and the way they can suppress the share price is by selling the underlying stock back to hold it down. That's why I think they're selling their underlying stock. So they have a wad of shares, and now people are buying out of the money calls. So to hold the share price down, they sell their shares back. Once their shares are at zero, they have to short it now. So that's what they were likely doing. Why? Because they've been losing $1 billion. So was Goldman Sachs losing their edge? And why? There's a big change that happened in 2020 to 2021. Who was this guy? Steve Mnuchin. Who is this? Upon graduating from Yale University in 1985, Mnuchin joined the investment bank Goldman Sachs, where his father, Robert Mnuchin, was a general partner. A general partner means someone who is very important at the firm. Mnuchin worked at Goldman Sachs for 17 years, eventually becoming its chief information officer, the guy in charge of the information. He was in charge of the money and the White House for 4 years. And the Goldman Sachs alumni, they worked together. So when he's the guy who used to be in charge of the information, and now he's in charge of the money for the government, do you think he was talking? Everyone said, oh yeah, that Mnuchin hotline bling. Oh, was this their edge? Why? Again, going back to the numbers, we can see that in 2020, they did excellent. In 2021, still an excellent year for the firm. In trading equities, not so great. Because I think that what they were better able to do is to say that, hey, by the way, in 2 minutes, there's going to be a tweet that goes out from a certain someone that's going to make the market move. If your position is going sour, now's your time to go scrape and fix it. That's not been happening. There is no more information edge. We're all seeing the same information at the same time and all able to interpret it and react to it in the same way, which means information is not the same edge it used to be. That's why I think Goldman is losing their edge. All right, so now we're to the bullish section here, where it's going to be a brief one, but there are some bullish catalysts. If there's this kind of liquidation underway here, you have to wonder how much further things could fall, said Perkins at Bespoke. On the other hand, this is the sort of pervasive negativity in selling is what contrarians look for as a sign sentiment has gotten carried away to the downside. That's our bullish catalyst. It's the only one. So price action is going to be what we look for. We talked about these levels before. Pause the slide if you want to read them. We're going to go into the charts now. So here we go. Here is the quarterly chart for SPY. The reason why I'm looking at this one here is because it's very evident what's happening here. In the quarter or year to date, we're down by 7.79%. It also shows a very flat base here at about 430. So, right, this is Q1 of 2022, Q4, Q3, and Q2. There is no real gain. We're engulfing the previous bar, and 430 is the shelf. We lose that shelf, it's going lower, below 400. That's the quarterly chart. Now we look at the monthly one. We've lost our uptrend. We're no longer going up, but we have a green line and a red line, which tells me that we're going sideways. So markets dropped 8% and we're going sideways. We're not even going down yet. We have a bearish engulfing candle in the monthly, which means we've printed a micro higher high by about $1, but we've engulfed the entire previous candle, lower low. Bearish. Now we look at the weekly chart. You're likely noticing a notable change versus the previous charts we were looking at. I've now adjusted it to show we've lost the uptrend. We have a short-term downtrend with 3 candles, and we're resting basically on the 50 MA. We're going sideways. We're not even going down yet. We're going sideways. So when we start going down, that is where the potential could start getting self-fulfilled. Here's the daily chart. Volume is definitely climaxing. 202 million shares traded on Friday. Why? Monthly OPEX, baby. These guys got to buy. Let's drill them. Let's force them to buy our shit. So what do we got now? Uptrend's lost. 432, that same area we talked about, the launch pad before we went to all-time highs. That's the blow off top. We got a test right here and a test right here. All these things are laid out in Slack. If you want to go read them, they're in the SPX channel under all my usual threads. Hourly chart, same thing here. Lots of damage. So as we're looking here, we can note that we got our relative lows, and our red line is now going to be 449. That is our monthly low for December. That's where this low comes from. After that, 451 is going to be the relative low after that. So as long as we're below 449, we're in a bear trend. We are below December's low. What does that mean? We're trending down. That's why there's a funnel lower. Whew. Good luck this week. Yeah. So what I'm going to do instead now is, since it's already an hour and 34 minutes, I'm going to go through 2 more sections now because I didn't have time to put these into the slides, but it's still relevant to go through. So these are now going to be the weekly charts for the indices. So for the ETFs, for QQQ here on a weekly time frame, just like S&P, it is technically going sideways, but there's warning signs because it's poking below the 50 moving average on the weekly, and it's also below 353, our previous top and low. What does that mean? Lower low and below the 50 MA, technically trending down. That's bearish. XLF, big test coming in here. If it can reverse, maybe it can help the S&P. I don't know, though. 50 MA is pretty close as well. Looking at XLV, our primary uptrend has now been lost, and we're rocking this lower uptrend, which is going to be roughly aligning with our 50-month weekly moving average as well. Looking here at XLE, slightly backing off, but it is persistently going higher. IWM, again, bearish. It's trending down. So now it's a matter of how much we're going to drop. The NYSE, same thing. Cracking that 50 MA, losing the uptrend. What is that? It's going sideways below the moving average. DIA, losing the uptrend below the 50 MA. Oh, crap. This is looking like there's a theme. It's only S&P that's missing. XLU, which is going to be usually a safe haven, is actually trying to rally. It's trying to break out bullish. Only down by 0.8% on the week. Incredible. Also a warning sign. TLT, or longer dated bonds, are up by 1% here. Why? Persistent inflation might actually last longer. The 10-year note, slightly ticking down. People are like, oh, crap, maybe inflation is going to last for 20 years, not just 10. Looking at RSP, or equal weight SPY, still technically above the 50 MA, but right at a key level. All it needs is a little knock, and it's going to lose that 50 MA. NYXBT, again, currently at about 34, 35,000. Solid downtrend, below the 50. It's bearish. Gold, moving higher. So that digital gold is not really the old gold. This is what I would see for a flight to safety too. Right, we look here, IHS pushing up the 50, 2 green weeks in a row. Boring, but it's green. On the monthly chart here, it's ready to bull break to a new all-time high. And then we got the dollar here. The dollar could add more pressure, or it could help the S&P and assets that are priced in dollars. Why? If Jerome gets more hawkish, the dollar is going to rise. That's just how it works. Dollar goes up, stocks go down. Inverse correlation. All right, now let's finally look at some of these options and then wrap it up. So looking here to Monday, incredible amount of puts from 440 down to 430. In terms of volume, we'll see if it translates over. Fat put flow. On Wednesday, 440 to 430 put spread continuation, right? 440 to 430. So there's a theme here. And then into Friday, the 28th, which would be after Wednesday FOMC, same thing, 440, 430. Yep. Then we look here at the SPY monthly. No visible straddles on the 16th, which means the 8 strikes above and below. What does that mean? No one's really betting we're going to get a big move. Everyone's just focused on insurance. That's why all the pink lines are over on the right side or the bear side. They're just buying put spreads. That's it. QQQ for next week. Sorry, this is beyond the 16s. We can see that from 440 down to roughly 420. That's the big put flow for the February monthly chain. They're already aggressively buying out. Looking at QQQ for next week, it's pretty muted. Sorry, let me go to here to QQQ. 360 to 364 call spread. I don't know that pays out, though. That's the only bullish thing I see here. They're probably buying early into Friday, thinking this is it. It's the bottom, and then they just got smoked. Looking on the put side, 360 to 350 for Monday. Wednesday's muted, which is actually FOMC day. And then into Friday, we're seeing the bearish continuation here. Looking into QQQ monthly, put spreads from 360, 350, and 340. And beyond the 16s, we see that put continuation all the way down to 330. So that's it. That's the video for this weekend. I would highly encourage you to just be prepared for the downsides. I wish you all the best of luck. And again, I would really appreciate a thumbs up and drop me a comment. We're going to try to help you as best we can as the cycle proceeds. And we will be on from Monday to Friday on our other channel, Blaze Capital, to walk you through the stock market open and everything we can do to help. Thank you. And thank you again for watching.